It almost feels like every single headline lately has something to do with China. Trade wars, gold prices going wild, and honestly, all of those are actually connected. What's happening right now isn't just another market hiccup. It's actually a part of a much bigger realignment of global power, trade, and money. The story starts with China tightening its grip on rare earths, the minerals used in pretty much everything from electric vehicles to fighter jets. All of the world's rare earths, just about almost all of them, comes from China, and that gives Beijing a huge leverage over US industries. And lately, China has been cutting exports, and prices have dropped more than 30% since spring. For the US, that actually means higher cost or production delays for anything that relies on those materials. European leaders are also calling it weaponizing supply chains, but really it's just a reflection of how trade has turned into just another front in a global economic war. Now, both the US and China, they're actually pushing towards what people call decoupling. US exports to China are down, and Chinese exports to the US are collapsing. And neither side seems eager to fix it. And with China's attitude basically being, we've survived for 5,000 years and we'll be fine without you. And the US is trying to rebuild its own manufacturing base, re-industrializing the country after decades of outsourcing. The problem is that America's industrial infrastructure, especially shipping, is basically a shell of what it used to be. And now China builds more than half of all new ships in the world. The US barely registers in this industry anymore. So when Trump's team talks about rebuilding America's shipping and logistics, they're going to have to start from scratch, and doing it also under fire, with China actively trying to make that process as painful as possible. China's strategy goes beyond ships and minerals. They've been using their economic muscle to discourage foreign investment in US industries, even sanctioning the American branches of foreign firms that were planning to invest there. It's a game of leverage, and both sides are using every single tool that they have. You have things like tariffs, sanctions, investment restrictions, or they try to squeeze each other. For China, the goal seems to be securing control over the materials and infrastructure that keep the global economy running. For the US, the goal is regaining independence from the Chinese manufacturing dominance. The problem is that both strategies hurt in the short term, and costs are up. Global trade is slowing, and is making investors very nervous. Then you have Russia and you have Europe, which add extra layers to this mess. The US has scaled back major aid to Ukraine, leaving the EU to pick up the tab. And Europe is trying to craft a peace plan that includes returning some of Russia's frozen assets. But that idea is basically a non starter. Russia's central bank reserves, worth hundreds of billions, were seized by Western governments after the invasion of Ukraine. Now, the EU wants to give back some of that money to Russia if it agrees to pay for Ukraine's reconstruction. But Russia doesn't trust the West after having its assets confiscated, and it's spent the last few years shifting its reserves into gold, or the Chinese yuan, and other non Western assets. About a third of Russia's total reserves are now in physical gold, which means they can afford to walk away from their frozen funds. The whole situation has turned into a warning to other countries, where the word and the message is that holding your money in Western currencies or banks is not as safe as it used to be. The loss of trust is one reason that gold has actually exploded this year. And according to Fortune, China has been the main driver of this year's gold boom. The People's Bank of China has been buying gold for more than 11 straight months, pushing its official reserves above 2,200 tons, and probably more since they could be underreporting for strategic reasons. Chinese households are also getting in on it too, pulling in record amounts of gold from the Shanghai Gold Exchange and piling money into gold ETFs and futures. So it's not just central banks, it's also regular citizens treating gold as both a safe haven and a speculative play. Add that to the macro backdrop, which is tariffs and a weakening US dollar, and the fear that global currencies are being debased by endless government spending. When Trump slapped 100% tariffs on Chinese imports, the US dollar dipped. Inflation fears rose up, and gold shot past $4,000 per ounce. Analysts started calling it the debasement trade, comparing it to the 1970s, when inflation and policy shocks sent gold up more than 2,000%. You even had veteran analysts like Ed Yardeni already projecting $5,000 for gold by next year, and even 10,000 within a few years if the trend continues. Even old skeptics like JP Morgan's Jamie Dimon and Citadel's Ken Griffin, people who used to dismiss gold, are now admitting that it's becoming a rational part of the portfolio. Even at Bridgewater, they're saying that investors should keep 15% in gold as a hedge against global instability. But markets never just move in simple straight lines. And after that meteoric rise came a hard reality check. As the Wall Street Journal and Barron's reported, gold just suffered its worst 2-day drop in more than a decade, down about 6% in a single day, and slipping again the next. Prices actually fell to more than $4,100 per ounce, which might sound bad until you remember that gold is still overall up nearly 60% this year, making 2025 its best year since the late 70s. And analysts say that the crash wasn't caused by a big change in fundamentals, things like interest rates, central bank buying, or inflation expectations, but by plain old profit taking. So it's almost expected that after such a big, crazy run up, that investors cashed out. Think of it like a breather rather than a start of a collapse. And even with that drop, the same forces that drove the rally, they're all still in place. Central banks are still diversifying away from the dollar, inflation is sticky, geopolitical tensions haven't gone anywhere, and the Federal Reserve is expected to loosen policy, which makes non-yielding assets like gold more attractive. The correction might sting and hurt a little bit, but it doesn't mean that the whole party is over. It's more like the market reminding everyone that no asset, gold included, can go up forever without taking a few hits along the way. So when you take all of this and put it all together, you can see how these threads all connect. A global trade war, countries hedging against Western financial systems, and investors big and small searching for something solid in a shaky world. China's dominance in manufacturing and shipping, it gives it leverage over physical goods, while its massive gold buying gives it influence over financial assets as well. The US is fighting back with tariffs and also with efforts to rebuild domestic industries, but those are going to take time. Meanwhile, ordinary investors are trying to protect their savings from inflation, from market volatility, and from currency swings. So that's where gold has become universal refuge. The irony is that the same tensions pulling the world apart economically are also tying markets together in a new way. China's rare earths cut hurt US factories, which rattles markets, which sends investors into gold, which China also happens to control a big chunk of. It's like a big feedback loop of geopolitics and money. The short-term sell-offs and corrections, they're just surface ripples. Underneath, the fundamentals, the huge debts, the currency shifts, the distrust between global powers, these are still pushing in the same direction. And whether you see this as chaos or the beginning of a new financial order probably depends on how much gold you already own. With that being said, that's about all I have for this video. Thank you for watching. Please like, please subscribe, and please leave me a comment.